The FDIC has put Silicon Valley Bank into receivership due to its inability to raise the capital it needed. The bank had $175 billion worth of deposits, $150 billion of which were not insured by the FDIC. Investors are anticipating some type of Fed pivot, but the events from today with Silicon Valley Bank have led to people thinking that the Fed is going to have to do something. Low interest rates have caused banks to take deposits and invest them in low-yielding paper, such as government bonds and Treasury bonds, which are considered excellent collateral. The U.S. government bought 10-year and 30-year Treasuries at 1.5% and 2% respectively, and also loaded up on mortgages. Silicon Valley Bank was in a difficult position due to their depositors wanting their money back, and they had to sell their mortgage-backed securities to cover their losses. This has caused them to lose a lot of money and they need help, but there is also something else going on. Banks are not paying their depositors enough interest to compete with the U.S. government on Treasury bills, and that this is creating a run on the banks. This has caused a lot of people to pull out their money from the banks, particularly those with large deposits. This is going to create a situation where the bank has to sell something to get it, but what they're selling isn't worth what they owe. Silicon Valley Bank was rated the best bank in America by Forbes and now it is insolvent in receivership. The problem is that all these banks are backed up by the U.S. government and the insured deposits are protected by the FDIC. This has led to a high inflationary environment, making it difficult for banks to pay a higher rate of interest when there is a lot of inflation. The Federal Reserve is doing quantitative tightening, leaving the FDIC with no money to bail out the banks. If the Fed decides to keep fighting inflation, the FDIC will have to sell bonds into the private sector, which will put downward pressure on the bond market and cause more banks to go and solve the problem. If the government has to sell bonds to bail out all the banks that own bonds, it will exacerbate the losses on those bonds, making the problem worse. If the FDIC defaults and depositors lose their money, the government may try to insure all deposits, but if the Federal Reserve does pivot and goes back to QE, the dollar will crash and inflation will run rampant, leading to the world waking up to what Peter Schiff warned since before the 2008 financial cases. QE has caused massive inflation. There is only one way to bring it under control, which is through massive cuts in government spending. Deficits don't matter as long as the buyers of government bonds have confidence that the government will pay back the money back, and that people still feel that they can pay for a long time. Eventually people will realize that inflation is not going to go away, and the only way to bring it under control is to cut back on government spending. There is no political will in Washington to raise taxes on the middle class or cut spending. The only taxes that will be raised are on the super rich. This has caused a loss of confidence in the bond market and a sovereign debt crisis. If the debt ceiling is not raised, the first thing the government will do is default on what they've already borrowed. This is the official acknowledgement that we are running a gigantic Ponzi scheme and that we will never pay off this debt. To avoid a massive financial crisis, the only way to avoid inflation is to monetize more debt. The potential for a financial crisis that is on an order of magnitude greater than 2008, and potentially for hyperinflation. This is now more likely than it was back then due to the 12 years of quantitative easing and the lack of action from politicians. The Fed has the tools to save the day, but people have been lulled into a false sense of confidence that they can do it painlessly. Robert Rubin came up with the idea to reduce the maturity of the national debt by selling short-term bonds instead of long-term bonds, which was a dumb idea because it put the short-term interest rate ahead of the long-term nature of the debt. Companies are buying long-term bonds to make money, and the Bank of England and U.S. pensions insurance companies are going to have to sell these bonds in a higher interest rate environment. The U.S. is going to have to pay the price for all the stimulus it received after the 2008 financial crisis. The dollar is going to implode on its own due to the enormity of the debt and the realization that it's unpayable. If the Fed chooses to preserve the dollar and let the Treasury default, they probably won't cut Social Security and Medicare. The Fed is also likely to do the wrong thing, as they have never done the right thing since Greenspan, and they don't even know what the right thing is. When the dollar goes, other countries' currencies will rise and their living standards will go up. However, in America, living standards are going to go down and we will have to produce more ourselves. Investors will want a premium to take the added risk of making a longer-term loan, so the yield curve is inverted and investors can get a higher yield on a 3-month, 6-month, 1-year Treasury bill than they can on a 5-year, on a 10-year, on a 30-year. People are buying long-term bonds to lock in the long-term rates even though they are lower, as they expect the Fed to go back to zero in a couple of years. However, when the Fed goes back to QE and cuts rates, it will unleash massive inflation, turning a bad inflation problem into a horrific inflation problem.